I've been a practicing attorney in the real estate and mortgage space for about 12 years. Also have some experience in consumer protection and class actions. So this lawsuit is something that I have a little bit of experience with from a couple different angles, and I'm happy to share it all with you. If you have any questions, I've got my co-hosts here taking a look at the chat, so feel free to ask them. They'll alert me if any of the questions come up, and we'll just kind of take them in real time and see where people are interested. So without further ado, let's get started. Just by way of disclaimer, I have to say this, nothing in this presentation should be construed as legal advice. Definitely make sure to speak with your attorney or your practice's attorney if you're thinking about implementing policy changes. And the opinions in this are my own and not necessarily the view of Total Mortgage. If you have any questions about any of this and where Total Mortgage stands, feel free to reach out to me after the presentation. So just to make everybody on the same page here, a quick review of what got us here. So we had a class action lawsuit against the National Association of Realtors and some brokerages as well. The plaintiffs, which are the people who are selling, are a group of home sellers. And they are saying that there was a violation of federal antitrust law, that there was a conspiracy to require home sellers to pay brokerage fees for buyers' agents. And they didn't think that that was fair. So they brought this suit. It went all the way to trial, and a jury rendered a $1.78 billion judgment in the case. And that was in October of last year. Rather than go ahead and appeal, the parties agreed to settle for a certain amount and make changes to the process. Just by way of review, there's a $418 million payment that's going to be made in 4 annual installments with interests. The details of that have been a little bit unclear, but it's going to be for the benefit of home sellers. So we expect that some money will go potentially to home sellers that have paid commission in recent years. There may be some investments in buyer or seller education. And I am expecting that we'll get some more clarification on exactly where that money is going as the rest of this unfolds. But for our purposes, what we're all most interested in is the changing to the listing practices. So our biggest change is that any offer of compensation is not going to be able to be a cooperative offer anymore. The practice of posting things in MLS and putting that out there is going to go away, and those fields are going to be removed from the MLS. Buyers agents must also have a written agreement with the consumers before they tour a home, and that must specify the compensation. And it's really important that everyone's paying attention to those terms and in those agreements, because the compensation that's set forth in those agreements, the consumer cannot be required to pay more than that. So if that agreement says 3% and somewhere down the line 3.5% comes up, even if that comes from another party, that's potentially problematic. So whatever's in that agreement can potentially cap commission. So it's really important to make sure that that's set in a way that gives you the right flexibility that you need. Sellers agents are going to have to make some disclosures as well on there. And if there's payments that the seller is making towards commission, then there's certain criteria about disclosing that, so that the seller is very aware that those that compensation is being made by them, and that everyone has to be informed very clearly that commissions are negotiable and that they're not set. And then negotiating compensation outside the MLS in alternative forums is potentially problematic as well. There are some emerging technologies that are coming out to negotiate real estate commissions, and we'll talk about that a little bit later. But how that interfaces with the terms of the settlement is remains to be seen. So right now, what's happening in court, the settlement was preliminarily approved by the judge on April 24th of 2024. That means that the judge took a look at it, said, this looks generally fair. Let's provide notice to the class, give everyone an opportunity to object if they feel like this is unfair or they don't belong in the settlement. And that will happen. That notice is going to go out on August 17th of 2024. And that's also the effective date of the changes. So a notice will be mailed to the class. They will say, this is the settlement. These are the terms. And also those changes are going to go into effect. There'll be a period at that time where objections can be filed. People can opt out of the class if they feel like they don't want to be a part of that. And that gives them the right to potentially bring their own suit if they want to. So this may not quiet all of the noise around commissions, but I think largely, there won't be a lot of meaningful objections that are going to change this in a material way. The final approval hearing date is set for November 26th of 2024. So at that point, the judge will hear any objections and any opt-outs. And it will also kind of take account for how many consumers or agencies or anything really opted themselves out of the settlement. Because generally, if there's a high number of opt-outs, that usually is indicative that there's something perceived as unfair in the settlement, and that may cause the court to want to renegotiate or reconsider. So we've seen some objections. The biggest one is from the Pulte Group, which is a large construction organization in the United States. But their concern was mostly about the distribution of funds so far, not about the mechanisms of how commission has to be negotiated. They said it's not really clear to us how that $418 million is going to be distributed, and we can't tell how much we're going to be entitled to of that. So therefore, we object. So we'll wait and see how the court handles that objection, but my guess is that there will have to be some kind of statement and guidepost for distribution of that fund. Any questions so far? Okay, so now that we're all caught up, since the settlement was announced in March, there's been a couple major updates. Fannie Mae and Freddie Mac have clarified that any seller paid commissions are going to continue to be outside of seller paid concession limits. So right now in underwriting on the financing side, there's generally a limit as to how much a seller can contribute towards the transaction. Historically, seller paid commission hasn't been counted into that calculation, but after this settlement was released, that was one of the first questions that the Mortgage Bankers Association had, as well as, a lot of other market participants. So they've clarified that basically everything's going to continue as normal in terms of underwriting calculations if a seller chooses to pay commission at this time. The interesting thing about the statements from Freddie Mac or Fannie Mae and Freddie Mac, however, have been that both of those statements rely on custom. So they say if the seller continues to pay commission in accordance with local custom, then we're good and we're not going to count that towards a seller paid concession limit. The interesting part is that local custom is starting to change. So 6 months from now, if it becomes that sellers never pay commission in a local jurisdiction, there may be some further shifts from Fannie Mae and Freddie Mac. I think lenders right now are really focused on, how are we going to evaluate local custom? Is that on a state level? Is that on a regional level? And where is that tipping point potentially where something is outside of custom? So at least for the time being, in the immediate future, we have this preservation, but there may continue to be shifts in how this practice is laid out. So in the fall, I expect we'll see some more unfolding and maybe some further policy shifts around these underwriting guidelines. I also think that the GSEs were really feeling rushed to get some kind of statement out. So they wrote kind of some ambiguous, loosely worded statements to just get something out there to preserve the status quo. And we may see them start to be a little bit more thoughtful about this when they've had more time to process. And then just last week, we had a major update from the VA, which was very helpful. On the 11th of this month, they issued a temporary authority under a circular. So it's technically a temporary permission to do this, but right now it's going to continue indefinitely until they rescind it. But veterans historically have not been able to pay commissions on VA loan transactions. But the VA is going to temporarily allow a veteran to pay reasonable and customary amounts as long as certain conditions are met. So those conditions on a high level is that the veteran is buying in an area where MLS can't be used to set commissions. So really anywhere that is subject to this lawsuit settlement. And that broker charges are not included in the loan amount. So they're coming out very clearly to say that, financing any of this into the loan amount is not going to work for them. And that the lender has to consider the the veterans compensation payment in determining asset liquidity. So they don't get any extra credit or anything, the money that is in their bank account when they, before they make the payment, we have to treat that deduction of the payment accordingly and evaluate what's left over after the commission payment. Seems to be what they're suggesting on that so far. I think there's been a couple of requests for clarification, but that's sort of the logical takeaway from that point right now. Any seller paid commission, and this is going to be disclosed in section H of the closing disclosure. So if you're in the habit of reviewing your closing disclosure with your borrower, that's where you would direct them to take a look at that amount. And then probably the most important takeaway for agents at this point is that any commission payment by the veteran borrower is going to be considered to be part of the sales contract package. So if you have a borrower that is paying commission, that really needs to be with the purchase and sale agreement, because the lender is going to need to upload it at the time that they're requesting an appraisal. If it comes after the fact, then it's probably going to need to be treated as an amendment, and it may be potentially problematic for getting that appraisal out as quickly as possible. So it looks like VA is looking to have this upfront and very clearly disclosed to the borrower at that time. They also made clear that negotiations are still being encouraged. So they want to see, I don't know how we're going to establish that, but they're just reminding everybody that, that back and forth negotiation process is encouraged on both sides. And that they are also not going to count any seller paid commissions as a seller concession. So just like Fannie Mae and Freddie Mac, that's outside the seller concession limit on these transactions as well. So I've had the privilege of being in the room with some of the discussions with other lenders, some brokerages, and some conferences on, how people are starting to respond to this. So these tiles represent some of the emerging trends that I've seen out there in the market and sort of predicting how things are going. The first one, as it relates to, realtors and buyers agents, is marketing shifts more towards courting buyers. I spent some time out at the Housing Wire conference in April, where the market was just starting to react to this. And we heard from the heads of some of the largest brokerages in the country. And they were really talking about how they're encouraging agents to make presentations to buyers the way that they would make them to sellers, right? Presenting really clearly to the buyers, hey, here's how I'm adding value to this transaction. This is what you're getting by paying my fee, and making it very clear to the borrowers and buyers that they are getting a service in exchange for the commission. Some brokerages are partnering with certain service providers as well to get some extra value add in there to help justify the commission to the borrower and really make them feel like they're walking away with certain things. So home services, transition assistance, things like that, in addition to your standard listing service or buying service, is something that we're seeing out there in the market. When I was out in April, which was less than a month after this settlement was announced, I had heard that states such as Arizona and California had already started to remove the commission lines in some of their MLS. So it looks like the Western states may already have a few months of experience in negotiating commissions outside of MLS, and taking away that presumption that these transactions are going to be seller paid. I haven't heard a lot by way of reaction as to how that's gone for them, but it is something that is happening already in a lot of markets out that way. And there hasn't been a lot of reaction to it, which I think is a good sign that people are finding ways to deal with this without it being entirely disruptive. It seems, there's a lot of concern about first-time home buyers and affordability. So I think it's fair to assume that we will see a rise in the popularity of down payment assistance and low down payment programs to further enable the borrower to bring less cash to the table at the time of closing. If they're paying, a 3% commission in addition to closing costs right now, that may be something that is preventing them from being able to get into these loans. So anything that is available to borrowers in order to reduce that cash at closing is going to be helpful. Another conversation that's happening a lot, especially in the lender circles, is the issues of joint representation. So when a single agent is representing both the borrower and the seller, as well as dual licensing. So when a single person is both the real estate agent and the MLO on the transaction. There are certain rules on the lending side about prohibiting dual compensation from a single transaction. So a loan officer can't earn a real estate commission and a loan officer commission from a single transaction. But there are some organizations, I think, that are starting to explore this, both on the realty side and on the lending side, where can certain representatives have licenses on both sides in order to consolidate the resources. So I don't see a ton of active engagement in that yet, but there are some lenders on the East Coast that have started to experiment with this as a model. So something to be aware of and something to keep an eye on as this moves forward. With that comes the idea of insurance implications. And this was a really interesting point that had come out of the discussion at the Housing Wire conference. But basically, at this point in time, there's buyer representation and seller representation generally, and each side of the transaction has their own errors and omissions insurance. So if something goes wrong, there are two carriers usually involved to come in and negotiate how that's going to settle. If things start to consolidate in terms of representation, where single agents are, representing both sides of the transaction, or there's dual licensing, there's often only going to be one insurer on that transaction. And I think the prediction is that the insurance companies are really not going to like that because it increases their exposure and potentially their liability. So we may see insurance companies come in and start to kind of dictate what they will and will not cover, or what level of disclosure needs to be made to the consumers in single representation transactions. So, we may see a rise in costs, we may see changes in coverage for dual representation, but insurance is definitely something that's we expect will come in and weigh in on, how this moves forward as strategies start to become more concrete. I also fully expect that we will see a lot of offers on the market. While commission can't be financed necessarily into the transaction, I do think we will see some offers where the purchase price is inflated by about 6% and suggests that the seller pays the commission on the transaction. And that seems to be, a generally passable way to do it, as long as, the loan to value ratios are in line and there are no expected appraisal issues. But so we'll probably see a fair bit of that coming in as well. If everybody starts to do it, I'm not really sure if that's going to be a good thing or a bad thing, but it's certainly an option. In terms of representation, we're seeing a rise in things like a la carte pricing and services as well. So certain online participants like Zillow are starting to offer, one-time only showings as a service to home buyers. So for a very small fee of, say, $50, this agent will come in and they'll show you the home. And then you can decide whether or not you want to move forward. And if you do, then the commission associated with that purchase transaction will be negotiated at that time. So that's one way that in certain states, places like Zillow are looking to kind of step around that initial agreement and commission negotiation. It's not going to be allowed everywhere, and a couple of states have reacted to that already with their local realty organizations saying it doesn't comply with local law. But we will, I think, start to see some of those creative arrangements where people are saying, okay, well, you can pay $50 for this, you can pay $100 for that, you can pay 3% for this. And we may see more flexible arrangements in that buyer agent relationship. In terms of market customs, I think that's another area to watch. We, just like different areas of the state of Connecticut have their own form for purchase and sale agreements, I think we'll start to see market customs emerge as well. Whereas you might see one trend in the northeastern part of the state where generally sellers are expecting to pay the buyer commissions, whereas maybe on the western side of the state, we're not seeing that as much. And how that's going to shake out remains to be seen. But I think bordering with states like New York and Massachusetts, a state like Connecticut may start to adopt the customs of whatever's in their region as well. So we may see different things in Fairfield County than we see in Hartford County. And that's going to depend on the bordering areas, but also the demographics, where the first-time home buyers, where the cash-strapped borrowers, those sorts of things will inform expectations. And the last tile is sort of a prediction of my own, and I haven't seen a lot of action or talk about this yet, but one thing that I've been watching with some of my attorney friends is, will there be an expected shift in the responsibility of settlement agents potentially? If borrowers are, out here trying to negotiate some of these a la carte pricing arrangements, are they going to try to expect more from settlement agents in the transaction, or are they going to try to expect less from settlement agents in the transaction? What will an attorney be expected to do as these home buyers are potentially paying their own real estate commissions? And as a last slide, there are a couple of resources here that I recommend to everyone. Housing Wire's been having some great coverage on this. There's also if anyone's an AI fan, ChatGPT has its own setup, or somebody set up a specialized prompting system where they uploaded a lot of the NAR settlement documents and local guidance. So you can actually chat with ChatGPT and ask questions and say, hey, where does it say XYZ in the settlement documents? And it'll get back to you with an answer. So it's kind of a cool tool just to go through and explore a little bit more. And I have a link to that I'll share in the chat when I'm done here. But it's a fun thing to play around with. The Mortgage Bankers Association has also been doing a lot on the lending side to get guidance out to lenders. So if you have some questions about how lenders are thinking about this or what's keeping lenders up at night, that's a great resource to go to. And Facts.Realtor is the National Association of Realtors website. They update their FAQs pretty regularly to answer questions about, how this thing is going down. There was some guidance recently about steering where they revised their FAQ to address some questions that had come up in that area. So very good resource to start with as things unfold. And with that, that's the formal part of the presentation, but I'm certainly happy to answer any questions that anybody has about the materials.
I have a question, Haley.
Sure.
This is Katie. Quick, so what are you seeing or hearing people wanting to include in the agreement to kind of not skirt around the requirements, but to comply with the requirements and still have flexibility? Like, are they doing a range? Can they do a range of compensation? Can they say, to be, up to X amount, no less than this? Like, how are you hearing people deal with that right now to prepare?
Yeah, that's a great question. And right now it seems like ranges are still acceptable. The biggest factor is that whatever's in that agreement with the consumer, they can't pay more than that. So I think an up to 6% or an up to 3% situation is still acceptable. Whether or not consumers find that to be assuring enough, I think is going to be where we start to see the limits. Meaning, if you sit down with John Smith and you say, well, you're going to pay up to 6% in this transaction, it just kind of depends on how it goes down. Is John Smith and his peers, are they going to feel comfortable enough with that to say, okay, I'm comfortable, I'll sign that document, or are they going to want a hard number? So I don't think we'll see that as much from the settlement as what we are required to do, but more what the market dictates is giving enough assurance to the consumers.
Okay, awesome. And then Linda Sullivan had a great question in the chat. She just said that she placed no less than 2% in the buyer's agreement. Does that cover her as of right now, based on what you know?
I think, I would want to do, a full review of that. I think because the emphasis has been around not exceeding what's in the agreement, I would have some concerns about no less than language, just because it doesn't really put that high end limit. And that seems to be what the settlement and what the related guidance is really concerned about, that they really want to put a ceiling on how much the borrower is required to pay. So that would be one that I would certainly encourage anyone to reach out to counsel on and get a full interpretation. But that would be one for me I would want to review.
Okay, awesome. Thank you for saying that. That makes perfect sense. Yeah, I never thought about the fact that if someone was representing me and they had, up to this, it's like, well, what would that include? And how do I know if it's going up to that, right?
Right.
Can they put language in the agreement that, no more than X amount paid by the buyer specifically and the rest paid by the seller's agent? Can they break it down that way, or is that not even a thing either?
That would potentially be something too. Again, I would hesitate in putting that in the agreement unless we're certain that the seller is making a contribution, because, the where they're expecting these agreements to come in is really before you've even shown any house to the buyer. To
Yep.
the buyer. So unless we're pretty confident that the seller is going to pay on this, putting anything in there that says the rest is going to be paid by the seller may be an issue under the prohibition on cooperative compensation, right? We're no longer allowed to presume that anything is going to get paid. So I don't think that that's necessarily impossible. I think if you wanted to get really creative with the language and say, if, the seller's not willing to make that contribution, then it's waived. There's probably a way to do that language. But I think it would have to be crafted really carefully to make sure it's in compliance.
Okay. Thank you.
Of course.
This is Kelly. I just had a quick statement. I put it in the chat. When you were talking about sort of the settlement agents piece of the puzzle here, just as sort of a side note for people who are listening, I think as a lender, we've probably seen it. I have definitely seen an increase in attorney written contracts over the last couple of months. And so those are generally for buyers who are making offers unrepresented. So they're going to their settlement attorney. And some of those, from the lender standpoint, I've had to kick back and say, this is not written in a way that us as a lender can utilize this contract. I've had some where it was an attorney took like the Greater Hartford Association of Realtors contract and just crossed off big sections of it, because that's written from the standpoint of a realtor, not of a settlement agent. And so it's definitely something I think for listing agents to kind of be aware of, that not all contracts are created equal. I think we know in real estate. And if you are working with an unrepresented buyer, so a buyer who's giving you a contract that's written by an attorney, you may see some increase from lenders kicking these back, saying, hey, we need addendums. Hey, we need to, re-execute a contract because something is missing on it, and things like that, because we've seen some kind of wonky contracts come through that just they're being written by people who are not always used to writing these contracts. I would expect that most real estate attorneys can obviously write real estate contracts, but that doesn't mean all of the clients are using real estate attorneys. So I had a contract that was written by a probate attorney who has never done real estate. So just something I think as a listing agent to keep in mind, that because I had one of the listing agents come back and then, we don't know why the lender's being so picky, and where I'm like, did you read the contract? I'm not being picky. The contract was very poorly executed. So that's just kind of a side note for agents out there, that we're definitely seeing some interesting contracts come through post this happening.
Absolutely. That's a great point. And, to anyone that works with, the same network pretty consistently, reaching out to your preferred contacts and just making sure that you are all setting expectations as to what your side of the transaction needs or is expecting, or what your policies are, is going to help. You can't control everything. And there is always that kind of, my cousin's an attorney guy that's going to come in. So we're not going to be able to keep it all out, but at least, if you're working 60 to 70% with the same network, I think we'll be able to reduce a lot of the friction by communicating upfront where we are and where you are.
Absolutely.
Awesome. Well, we really appreciate your time. I want to be cognizant of the group's time as well, because we end at 10:30. If anyone has any specific questions for Haley, feel free to message any of us on this call, and we're happy to relay the answers. Or if you have a particular situation that you want to run by us. And we just urge you to just keep partnering with the right people so that you can gain the knowledge and really thrive in this industry. I know I've had a lot of agents who are like, I don't know if I want to do this anymore, or maybe I won't work with buyers. But I believe personally there is a way to still do it and still be very profitable and help as many people as possible. And hopefully we can help along the way as well. So thank you so much for your time, Haley. We really appreciate it. And we hope to see everyone next week at the same time for our next episode.
Thank you all. Good luck.
Bye, everyone.
Take care.